Let's get a sense of the state of South Africa's banking system and the economy, which were the chief focus of the recent annual general meeting of the shareholders of the Reserve Bank. Here is Kganyago, the Reserve Bank governor, during his presentation at that meeting addressing the shareholders.
We have survived the onslaught of COVID-19, but South Africa now faces multiple challenges of high inflation, low economic growth, and a difficult external environment. Despite the easing supply chain pressures and lower commodity prices, global inflation remains well above many central banks' targets and monetary policy remains tight. These conditions, including rising uncertainty and weak confidence, have been a drag on growth for many emerging market economies, including South Africa, whose post-pandemic recovery has been comparatively weak. Electricity shortages, infrastructure challenges, high public debt levels, and weak investments continue to weigh on growth over the medium term in South Africa. Lower commodity prices have supported disinflation, and headline inflation returned to the target range in mid-2023. However, inflation remains sticky, and the risk to the medium-term inflation outlook remains to the upside. Monetary policy continues to remain focused on returning inflation to 4.5% over the medium term. Yet, this goal will be complicated by challenges such as the ongoing geopolitical tensions and climate change. Early in the pandemic, aggressive fiscal and monetary easing was aimed at mitigating the economic effects of the pandemic. As economic activity slowly resumed, supply chains remained severely constrained, prompting a sharp increase in global prices. The inflationary impulse was worsened by Russia's invasion of Ukraine, which raised the prices of important commodities such as food and oil. In response to elevated inflation, most central banks raised policy rates. Global inflation peaked in the third quarter of last year and has since moderated into the third quarter of 2023. This deterioration almost entirely reflects lower food and oil prices, alongside less binding supply constraints and tighter macroeconomic policies. However, inflation remains above central bank targets, and in the advanced economies, core inflation remains uncomfortably high, reflecting sustained spending on services, tight labor markets, and robust wage growth. While the rising interest rates triggered some banking sector volatility in the United States and the Eurozone, this appears to have diminished in recent months. These market-related stresses were not enough to derail the hiking cycles of the advanced economies, with the US Federal Reserve and the European Central Bank hiking by an additional 75 and 100 basis points respectively since March 2023. The persistence of inflation, despite the sustained interest rate hikes by some central banks, suggests that global neutral interest rates have risen well above their pandemic levels. As we move towards 2024, central banks around the world will be watching carefully for additional evidence of changes in neutral real rates. With global financial conditions adjusting and risk-adjusted real interest rate differentials widening, portfolio flows will become less certain, affecting the availability and the cost of external funding. These rising credit costs will further impair the financing of large fiscal and current account deficits in many emerging market and developing economies, including South Africa. Many economies have experienced sustained increases in public debt levels, which with higher inflation create serious headwinds to economic growth. As exchange rates depreciate in response to the more adverse credit conditions, imported inflation tends to rise, a trend already seen in producer prices, fuel costs, and food prices, among other items. Emerging markets and developing economies will need to consolidate their fiscal positions over the coming years, helping indirectly to reduce exchange rate pass-through pressures and inflation and ease wide-ranging economic costs. South Africa's recovery from the COVID-19 pandemic was driven by demand expansion and a supply rebound following the easing of pandemic-induced restrictions. This generated a strong but incomplete recovery from the 6% construction experienced during 2020. While growth rebounded by 4.9% in 2021, activity subsequently slowed to 2% in 2022, and by 2023, even lower growth was expected as the energy crisis facing the country worsened. The South African Reserve Bank forecasts gross domestic product growth at 0.4% this year and expects it to average about 1% over the next 2 years. South Africa's post-COVID-19 recovery reflects various domestic idiosyncrasies such as the July political unrest, disruptive strikes, extreme weather conditions, and failing infrastructure. Although load shedding entered the South African lexicon 15 years ago, it has intensified over the past 2 years, placing a binding constraint on growth. The South African Reserve Bank estimates that growth over the 2023 to 2025 period would be closer to 2% in the absence of load shedding. South Africa's underwhelming economic performance is not new. The country's chronic low growth problem predates the pandemic. In the 5-year period before COVID-19, growth averaged just 1% compared to the 3.5% growth achieved by typical emerging market economies. One of the main challenges to achieving higher growth is weak investment levels. South African investment lingers close to 16% of GDP compared to the 25% level achieved by comparative peers. From a macroeconomic perspective, a key constraint to achieving higher investment levels in South Africa is persistent fiscal dis-saving. Higher public debt levels raise the risk premium, pushing up the cost of borrowing to around 11% today. The low investment problem is worsened by the composition of public spending, which is geared more towards current consumption than infrastructure. The reversal of the economy's terms of trade risks, worsening the fiscal outlook. Between January 2020 and March 2022, the prices for South Africa's major commodities such as gold, iron ore, platinum group metals, and coal doubled. Since then, however, these prices have been falling consistently and by as much as 23.8% over 6 months alone. As funding needs grow and as domestic saving remains weak, the need for foreign savings has widened. The current account deficit is now expected to expand from 0.5% in 2022 to 3.3% in 2023. Headline inflation rose sharply in this past year, surpassing the upper end of the 3 to 6% inflation target band in April 2022 and reaching a 13-year high of 7.8% in July 2022. Inflation has since moderated, albeit with some volatility, and finally returned to the target band in June 2023 when it reached 5.4%. The moderation can largely be attributed to lower food and fuel prices in the recent months, as well as lower imported inflation due to easing supply chain disruptions and easing demand conditions. A more pronounced moderation in inflation is expected in the latter years of the forecast horizon, with headline inflation expected to ease to an annual average of 5% in 2024 and 4.5% in 2025. The risks to the inflation outlook are assessed to be on the upside. Rising services inflation and elevated administered price inflation continue to put upward pressure on prices. These pressures are exacerbated by elevated and rising inflation expectations by key price setters over the medium term.